Are you tired of losing money in trading? Trading can be challenging, but it doesn't have to be. In this video, I'll share with you how to use stop losses to maximize your trading profits while minimizing your trading losses. We'll cover what they are, why they are important, and how to practically calculate them correctly. So first things first, what is even a stop loss? So a stop loss in layman terms is ideally the maximum price level that you set to be able to ensure that you don't lose any more money for the trade that you are actually in. Let's say you decide to buy Bitcoin at the price of 20,000. You want it to go up, but you want to make sure that if it goes down in value, you actually don't lose more than a certain set amount. So you can decide, for example, that if the price of Bitcoin goes from 20,000 to 19,000, I want the trade to automatically cut off, and whatever loss I've had up to that point, let me take that, because I don't want to lose more if it continues below 19,000, let's say 18, 17 and more. So the stop loss price level in this particular case is the 19,000. So how are you able to really determine whether you should use 19, 18? So how can you be able to calculate that? So just a short story of my experience with stop losses. When I got started in trading way back in 2013, I was very excited because I started finding various ways of being able to find good trading opportunities. So one of them was, for example, candlestick patterns. So I learned a few candlestick patterns online just from a quick Google search. So what I decided to do was I'll go to the charts and now find actual trading opportunities in live market. And I actually found them. Then there was a problem. I am a risk-averse person. So the challenge that I had at that particular moment is, how can I make sure that I don't actually lose a lot of money when I actually get into these trades? So what should that particular stop loss price be? Because I'd learned about it. So when I was Googling online, what is the best stop loss placement to be able to use, I found a common advice is use a 20 to 30 pip stop loss. So I thought, so people are saying if I use a 20 to 30 pip stop loss, I'll be okay. Unfortunately, after the period of about 3 months, I actually blew up my account. Man, I've just lost almost everything that I had in my account. So it was a very stressful moment for me, and I decided that particular moment to actually take a break from trading for a while, because I was wondering, why is it not working? I have found the entry strategy. I have used the stop loss placement that is being advised, 20-30 pips, but I've just blown up my account. So while I was in that period of mourning over the amount of money that I had actually lost, I actually came across an article online that was talking about an indicator called the average true range indicator. So it's an indicator that usually actually shows you the volatility of a market over a certain period. So that then, if you can be able to determine how volatile a market is at the moment and base your stop loss based on that volatility, then you can be able to limit the amount of losses that you have based on just random fluctuations. So I was very happy finding this particular indicator, and I decided I'm going to implement it now in my trading. And surprisingly, I stopped actually losing a lot of money in my trades. I never blew up my account after that particular period after I started implementing this particular indicator to determine my stop losses. So how exactly did I start using this average true range indicator to actually minimize my trading losses? Before we look into that, I'd like to share with you my free training on the 7 steps to financial freedom through trading. It is an amazing training that will give you a step-by-step plan on how you can actually start trading for a living. If that is something that you are interested in, then you'll find the sign-up link to this particular training on the pinned comment of this particular video or on the video description. So let's get into how I actually use this particular average true range indicator to calculate the best stop loss price levels based on my experience. So this is an example of a chart of the pound Australian dollar, and here on the right we have an example of an entry signal. This is called the tail bar signal. So the recommended way of entering a tail bar is usually at the 50% mark. Let's say, for example, we would say our entry price is this 1.7368. So I'll go to an Excel and just put 1.7368. Now we have our entry price, but then we don't know what our stop loss price should be. So since you're expecting to buy, we want our stop loss to be below the entry price. So using what I was mentioning, the average true range indicator, how to add it, this is on TradingView. But on any particular charting platform, you should be able to find this indicator. You'll be able to find this particular indicator at the indicator section here. Then you'll go to average true range, just search for it. I added it on my favorites, but just search for it. Average true range will appear here. Click on it. Make sure you click the average true range, not day range. So at the bottom, you'll actually be able to see a line at the bottom that shows you the average true range over this particular period. So how exactly do you actually set it up? So it has some numbers here, but just to change a bit of settings for it, when you double click on the line, this settings page will appear. So under inputs, under time frame, I always select 1 day so that the average true range is based on the daily bars. Under length, I change it to 10 so that it's an average of the previous 10 days. Then under smoothing, I usually use simple moving average for the smoothing. And that's all you need to set. You don't even need to change the other style and visibility. You can keep it as is. So 1 day, 10 SMA. And then once you've done that, now if you go back now to our tailbar, when I hover over it, I put my cursor over it, I would actually see a value at the very bottom here. So the value for this one shows it's 0.0146. So what that shows is that over the last 10 days, it has actually been moving over a range of 0.0146. So this can be converted to pips, which would be about 146 pips, but don't need to worry about that. Just take the number as it is, 0.0146. I'll take it to my Excel sheet. So 0.0146. Now we have the 10-day TR. Now based on this, a very simple way you can be able to determine your stop loss, since you are buying, would actually take the entry price minus the 10-day TR. And based on that, we have our stop loss price. So it's ideally 1.7222, which would ideally be somewhere around here. So just to draw it in, so at least we can be able to see it. So we mark it in red, so you can see it here. So we have our entry price at 1.7364 and our stop loss way below down here. So that is one simple way in which you can be able to use the average true range indicator to be able to determine your stop loss price. If it was the other way around, if for example you wanted to determine you are looking to sell and then you want to determine the stop loss price, we would just do the opposite, whereby instead of subtracting from the entry price, we would actually add. So it would actually be something like the entry price plus the 10-day TR. And that would give you, for example, you are looking to sell that particular market. There are various derivations you can be able to do this. People would sometimes do, let's say, 1.5 of this value, or sometimes 80%. It depends with backtesting. But a very simple way is just taking the 10-day TR. If you are buying, subtract it from the entry price, you get your stop loss price. And vice versa, if you're actually looking to sell.